Welcome to the Week in Review, brought to you by Inverse. Investing makes sense when you learn by doing. If you're wondering what happened to the week ahead, we have to apologize as we got distracted by the first item to cover this week is the U.S. labor report. The U.S. labor market delivered a sharp downside surprise in February, with employers shedding 92,000 jobs, a dramatic miss, versus expectations for a 60,000 gain. The unemployment rate ticked up to 4.4%, and prior month's data were revised downward, painting a weaker picture than previously understood. However, low numbers are likely influenced by strikes and winter weather. Next to review is Next is Canada's labor productivity. Canada's Q4 productivity report shows a mild pullback, driven by weakness in goods-producing industries and rising labor costs. But the broader story is more balanced. 2025 still delivered positive productivity growth, and much of the Q4 softness reflects temporary trade-related pressures rather than a structural decline. The bigger watchpoint heading into 2026 is whether rising unit labor costs and trade uncertainty continue to squeeze margins and slow output. The Eurozone's February flash CPI shows inflation nudging back up to 1.9%, slightly above expectations. Services inflation remains strong, energy's drag is fading, and core pressures are still firm. The report reinforces the view that inflation is stabilizing rather than sliding, making the European Central Bank's spring rate cut path more uncertain. In our ongoing earnings report, the change in quarterly earnings this week was minus 62%. Now let's talk about the energy markets. Energy markets were rocked by the escalating U.S.-Iran conflict, which effectively shut down the Strait of Hormuz, sent oil and gas prices surging, and triggered broad risk-off sentiment across global markets. Analysts have warned that if the blockade persists, oil could spike to $100 to $150 in the coming weeks. Natural gas prices in Europe were hit hardest, as they jumped 61% in a week, caused in part by the disruption of LNG exports from Qatar and the UAE. U.S. gas prices jumped 11 to 12 cents overnight, with the national average moving above $3 per gallon. Energy-driven inflation fears pushed global equities lower, especially in Europe, where traders scaled back expectations for bank rate cuts due to the inflation shock. In our opinion, we see three big risks on the immediate horizon. A sticky inflation scenario where growth is cooling, but inflation doesn't fall as cleanly. A Fed stuck in wait-and-see mode as weak jobs alone won't trigger rate cuts if wages and inflation keep pressure on inflation, and a more volatile macro backdrop where energy shocks and labor market noise lead to choppier data and choppier markets. And of course, there's also the risk of war. Well, that's all for the Week in Review. Remember, folks, if it walks like a and quacks like a then it's probably a
Regard y'all, what is it good for? Absolutely nothing, say it again.